Hello, everyone. Welcome to our session today. 5 reasons why hiring a tax planner could be more important than hiring a financial planner. Okay, just a quick declaration. This presentation is for information only. So before you make decisions, make sure you find a professional support. And also, we're not financial planners or solicitors, and will not provide financial advice or legal advice. Okay. Okay, let's have a look. Before we go to the 5 reasons, just want to mention, in Australia, most financial planners actually don't provide tax advice. Sometimes they mention that they do provide tax planning combined with financial planning, but generally speaking, the nature when they provide tax planning is actually more in general sense and also broader as well. Um, so this could actually cause taxpayers to miss major tax saving opportunities or even choose inferior investment products. Okay. And also in Australia, only a very small portion of tax agents provide advanced tax planning advice. Because of this, you do need to choose a tax planner carefully. Okay. Don't just blindly trust any tax agent. And also, tax planning with financial modeling is actually a unique service provided by us, and it's not a common service provided by other tax planners in Australia. Okay, I just want to mention that so that it's clear to everyone. All right, so let's go to the 5 reasons. The first one, correct tax structure could be more important than investment products. Okay, so tax on different ownership for the same investment could be very different under individual ownership with different split. Sometimes it can be 50-50 or 90-10 between husband and wife, okay? Or if they are captured in family trust or company or self-managed super funds, okay? And that's because different structures got different tax rates, and it can be even more complicated when family trust got different beneficiaries with different marginal tax rates, and or with a bucket company, okay, or corporate beneficiary. Then it's going to be more complicated. But those structures need to be included in the considerations because um, if we don't compare different scenarios, we wouldn't know which one is the best for the investors to minimize their tax and to achieve the best after-tax income. Okay, after tax is key at the moment. Okay, because the best way to make an informed decision is actually comparing after tax cash flow. Okay, using financial models. Okay, because most of the financial modeling in Australia, so far as I know, they are focusing on before tax. And because Australian tax law is too complicated, I actually personally tried to find a financial modeling software to include tax component, but it's impossible. It's very hard because there are too many layers of considerations and too many possible variations. So it's impossible or close to impossible. Okay, so this is the reason why sometimes we mention maybe financial planners don't have enough expertise, but also it's very hard to create a financial model including tax. Okay, that's why we have developed a model using Excel because there's no software we can find on the market. Okay, so and then here is a small example, okay, to show you why tax structure could be very important. Okay, so here is actually based from a real scenario for a client of ours. So when we build the model for their investment property, we can actually see from 4 different models. The scenario 1 is 50-50 split, scenario 2, 90-10, family trust 100% of the purchase under self-managed super fund. Okay, as you can see, the 4 different scenarios are very different. If we combine income tax and capital gains tax, it looks like the second scenario, which is 90-10, is actually the best for the couple. Okay, but the situation could be very different if it's a different couple and have very different income from this couple. So we do need to look at individual clients separately. Okay, every taxpayer could be different. Okay. All right, the second reason, wrong product could be chosen when tax is not considered. So financial planners tend to choose product based on the return of investment rates. Okay, so it's like ROI, return on investment, after deciding client's risk preference. Sometimes they do consider a bit of a tax structure, but not too complicated. And then sometimes the issue here is different product with different investment return would attract different tax rates. And there's a say, very simple example, interest and dividends. Interest is actually just an outright income. You pay tax on your marginal tax rate on every dollar you earn. Okay. And then dividends, you do have what we call imputation system. So franking credit. So that means if the company have already paid tax on this income on the company level, and you are receiving their after-tax income as dividend, you can receive a tax offset called franking credit back. Okay, and if in case your taxable income is below tax-free threshold, you will receive this franking credit back as a refund. Okay, so on surface, interest and dividend, they might give you the same return, but underneath after-tax income is totally different. So they should be treated as totally different financial product. And after tax, the tax component need to be considered. Okay, so other factors that got to be considered as well, sometimes actually missed. Okay, different marginal tax rates between the couple. So sometimes if, let's say, we do have many clients falling in that category. Sometimes the husband might pay a tax like 47% of the marginal tax rate. The wife might be paying zero, okay, before, because her income might be below tax-free threshold. Then the financial product need to be considered maybe differently for both of them. Okay, so for the husband, if wherever possible, consider investment that could have some tax offset or could generate some tax loss that husband might be able to claim. Okay, so then, but if the same product 50-50 allocated to both husband and wife, then a part of the tax benefit could be wasted. Or on the other side, if like say for interest or some income, investment income, if there's no tax credit attached to them, then the husband will pay full 47% top marginal tax rate, then that's penalizing for the couple. So that's so we need to look at different people, what's their marginal tax rate, especially when it's a couple, okay, husband wife team, what type of investment product they should choose. So and of course dividend imputation I mentioned earlier, and also timing and amount of taxes. So some products might offer tax benefit earlier, while others might offer the benefits later. So the timing need to be considered. Also, the future plan. When would the taxpayer want to sell their investment? So even a rental market, let's say, for example, apartment close to new, that's very different from old building on a big piece of land. Okay, because the old building on the big piece of land, the main focus is actually on future capital gain. And then the apartment close to new, the main focus could be on the upfront savings. Okay, if you can create tax loss from it, you can use it to offset other income. So then all the strategies need to be combined, considering tax as well. So if you don't consider other income, and then maybe incorrect product could be chosen as well. Okay, so timing is quite important as well. And then that's the reason why we don't undermine a financial planners' importance. Okay, they are doing important jobs to help Australian people, okay, mom and dad, simple or just common families to achieve their financial goals. But the point we want to make here is tax planning is super important. Even if you are using a financial planner, please make sure consider finding a very good tax planner to help you as well. And then make sure that you are utilizing all the tax benefits or you're investing on the most tax efficient way. Okay. So number three, tax planners could provide instant savings from year to year. So tax planners, we tend to be able to see more opportunities because it happens quite often when we help our clients to prepare their company return or family trust return. We might be able to see the pattern or maybe there will be missing deductions. We can see it right away. Some of the deductions could be quite a lot in terms of tax saving. Okay, so this is quite important, and also this is especially important with items that will need advanced tax planning knowledge, such as equity exempt items. Yeah, those ones I doubt even in the tax planning industry or tax agent industry quite often when we receive new business clients, nobody heard about some of the FBT exam items we mentioned to them. Yeah, it probably happened once only. Yeah, we have like probably how many like multiple like dozens of business clients, and then only probably once that someone heard about it, but actually still didn't apply related knowledge and someone changed tax agents for like 5 different tax agents before, and he never heard about some of the FBT exempt items. So that's actually important. That means you actually got to find a really good tax planner to help you so that you don't miss those important items just to help to save tax. All right, we do have many other YouTube sessions on our channel, so please make sure yeah, watch those. So I don't want to use too much time to mention the tax saving strategies because there are too many and taking too much time. All right, and then okay, number 4, tax savings and reinvestment of tax savings are not included in financial planning. So this is generally the case. So with advanced tax planning, a taxpayer could save up to tens of thousands of dollars each year. With our business clients, yeah, with the business restructure, or sometimes we help them to save 20, 30K or sometimes more each year on tax. So the power of reinvestment of the tax saving should be included to help clients to understand their future situation or make important financial decisions. So because this tax saving, every year if you can save this amount of tax, you could maybe move forward your future financial goals earlier, okay? And then or you can potentially change your other goals, financial goals, okay, to maybe try to have a little bit more time, okay, spent with your family if you know you're going to achieve the financial goals anyway, okay, in that number of years. And of course, and then on the other side, we with any capital gain in the future, potentially, yeah, that could present major changes to your after-tax cash flow. Because when you think about if you're selling a rental property, depend on the timing you're selling it. If you're selling before retirement and you have a huge income, employment income there already, then if the property is attached to your individual name, your capital gains tax could be up to 47%. And then maybe a major chunk of your sales proceeds will be paid to tax office. So if in your financial planning, you actually factor in the value increase on your property, and then it might be a big shock, okay, if you don't consider tax at the end when you're selling the property. Okay, so this is really important. So you have to consider tax in your financial planning. Okay, so this could be critical for your future decision making. Okay, you have to consider tax. All right. And then number five, lower cost, considering the value. Okay, so that's talking about the tax planning. Okay, when we compare to financial planning. So in Australia, the average financial planning service, the cost is up to $6,000 a year, including retirement planning, and up to $13,000 a year for complex structures. Okay, a big part of this pricing is actually related to mainly the government regulations. Okay, as a financial planner, they have to provide a PDS document, okay, product disclosure statement, and SOA, statement of advice documents to their clients if they are providing financial product advice. Okay, and for us, we roughly charge about half of that price. Okay, or we can go even cheaper for a very simple structure. Okay, and then the reason being we don't provide financial product advice. And I actually deliberately didn't want to get into financial planning industry, yeah, because for one, the licensing fee is really expensive. And then I personally feel that there's a huge value that's actually attached to tax saving. That could be more important. And then we want to deliver that value to our clients with a reasonable price. Okay, and then we're actually trying our best to see whether we can provide very simple modeling to like average taxpayers, maybe even below 1,000. We're trying to, in the process, to be able to achieve that using more automated Excel calculations. Yeah, so maybe it will be happening in the near future. Yeah, but at the moment, roughly we charge for, as a starting point, $3,000 plus GST. Yeah, and then for a business client, yeah, it could be 5,000 or 7,000 plus GST, well, depend on the structure, okay? And then the feedback from our power planning clients indicates that our service actually deliver substantially greater value than typical financial planning services. Yeah, we do have a lot of power planning clients who came to us after they have used financial planning for a second opinion, or they are still using financial planning services, but also combining the services with our tax planning. And that's actually very important. So as a starting point, I think everyone should have tax planning. If you have, especially if you have a little bit of surplus cash, yeah, you can leave behind, to plan for the future, especially, maybe potentially future retirement. Then you got to do some tax planning to see where is the best structure, okay, to invest that money for your future. All right. And then here I've shown you this picture in many other sessions. Yeah, so it's just a comparison if you don't have any strategy. Okay, so they're both after tax, by the way. Yeah, when we build our financial modeling, we only compare after tax. Okay, so if they don't have strategy, this couple, they're going to use all their net assets when they're 84, okay, in their 80s. And then, but if they combine all different strategies, especially combining with a bit more complicated structures, like maybe a family trust with a backing company, then reinvest their income from the backing company through a Division 7A loan, then they're never going to spend their money, all their net assets. Yeah. So of course that's combined with super contribution as well. So concessional, non-concessional combined. So then they're going to achieve the result is still going to be upward trend, even when they're in their 90s or close to 100. Okay, so that's the difference we make. All right, a brief introduction about myself. CPA, RDA, founding member of SOPEPA, Master of Commerce, and Master of Financial Planning. All right, and here are my contact details. And we call ourselves accountants for people who want to grow their wealth. So if you're one of those people, please come to us. Okay, and then also our office contact details as well. All right, that's everything. And thank you so much for joining us for today's session. We look forward to see you in our next session.